Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. March 12th, just after the close. Another good dose of volatility this week. Saw it in both bonds and equities, and some of that velocity in the 10-year and 30-year yield upward, putting some pressure on large cap growth. Important to have your portfolios barbelled here. If you're a straight S&P passive investor, even paired with the NASDAQ 100, you may be disappointed. Certainly over the last 6 months you've been disappointed. Going forward, it may be more of the same. I wanted to share a performance chart going back 15 years. It's the U.S. size and style performance chart of the Russell indexes. And what jumps right out at you is 5 of the last 6 years, the Russell Growth Index has been the key performer, has been the strongest performer out of the indexes. That's unprecedented in the last 30 years to have that kind of consistency in one style. We're starting to see that ebb, obviously. Value has been where you want it to be this year. Now the question for your portfolios and for our portfolios is this a short-term scenario where we have to just grin and bear it on the large cap growth side? Or do we really have to start severely underweighting large cap growth? Difficult to say. In our U.S. equity portfolio, we've been the beneficiary of diversification. Remember, diversification became a 4-letter word for the last 5 years. Really until July, August last summer. You had to be large cap growth, S&P 500, NASDAQ 100, and that's it. If you were anywhere else, you had an anchor weighting down your portfolio. Boy, has that changed. That's changed to the tune of 2.5 to 3x the performance in small and mid versus the S&P. Stay flexible. The biggest mistake we can make as money managers or investors or traders is getting locked into thinking that there's one way to invest. Look at your portfolios. Look at what's working and what's not working. Don't be afraid to rotate into some areas that you may not have used the last 4 and 5 years. And by the way, that includes international. Solid performance out of the developed markets. Emerging markets have taken it on the chin recently, but in terms of their last 6-9 months performance, very strong. Again, flexibility, diversification. That U.S. equity portfolio has been helped immensely from a small and mid-cap holding, a value holding, a financials and banks holding. Very strong. We look over the last 12 months in that portfolio, outperforming the S&P by 7-8 percentage points, 700-800 basis points. This year, S&P up 4 and change, that portfolio up 7 and change because of the diversification. So what was a negative for years is now becoming a positive. The key, the big question is, does that last? I don't know that, you don't know that. The important thing for us to look at is on weekdays, and we've had a few of them, where does the money come in? What bounces first? That's relative strength. What outperforms in weekdays? I'm much more interested in that than what's working in strong days. And in each week period, over the last 6 months, demand has been in small, mid, and value. Doesn't mean we jump entirely out of growth, but we have to respect supply and demand. Have a great weekend. We'll see you next Friday.
Good afternoon. I'm John Mousseau. I'm the CEO and Director of Fixed Income here at Cumberland Advisors. It is Friday afternoon on March 12th. Another continuing saga. Higher treasury rates, good equity markets. This week we saw the 10-year bond go up from about a 156 to a 163. The 30-year bond from a 230 to 238. What's significant about both those moves? In the case of the 10-year bond, you are back to where you were before everything fell apart a year ago last March. So that has been the long, strange trip from a 163 all the way down to a 0.3 earlier in March last year, back to a 0.5 in August, and now back to a 163. 30-year bond. At a 238, you are basically where you were when you started 2020. Some of the papers call this a bond market rout. We disagree. We call it a return to normalcy. And it is certainly baked in as you see better vaccination rates going up. And you see this reflected in other parts of the bond market too. Municipal bonds this week. Yields not higher. Yields actually dropped by 7 or 8 basis points. So that a 10-year bond is about a 102 at AAA, and a 30-year bond is about a 165. Those are yield ratios to treasuries back down in the 60th percentiles. Not as absolutely low as they were a few weeks ago, but pretty darn low. It tells you that spread product, anything other than treasuries, has been narrowed a bit. Corporate credit hardly moved at all this week, a little bit. This tells you that as yields are moving up, people do have confidence in companies and municipalities as you come out of this mess. The $1.9 trillion stimulus bill got signed this week. $350 billion in it for state and local governments. That's a good thing. That's certainly reflected in the market. It's also reflected in the fact that you saw positive inflows into bond funds, municipal bond funds this week after a few weeks of outflows. We saw the economic news this week. Initial jobless claims still too high in the 700s, but the market's shaking that off because it's pointing towards a better vaccination rate and an economy that is starting to come out. So the good news is overwhelming anything that's out there that's rising yields and stuff. One thing that we get the question a lot is that, hey, I read about the Fed is keeping interest rates low, so why are bond yields heading higher? It's very simple. The Fed can really control the short-term interest rates through the Fed funds target rate, which is 0 to a quarter. And it's been there since last March. And it will be there for a while. We know that the Fed cannot really control long-term interest rates, even if they're out there buying treasuries and mortgages in the longer part of the bond market, which they are. We saw that in 2013 with the taper tantrum. The Fed was buying bonds, but yields went up when the markets were scared that the Fed might pull back sooner than later. Our friend Jim Bianco compares the bond market to a horse. And if horse is tethered up, and when the horse is tethered up, it's usually pretty docile. But when it starts bucking, it can pull the post out of the ground. And right now the horse is bucking a little bit. We expect it to calm down. One thing you also have to look at is inflation. Inflation this week crept a little higher. CPI month over month was 0.4. Core CPI was a little less at 0.1. So I guess what you can say is that inflation fears are moving up. Inflation expectations are moving up. Absolute inflation levels are not really moving up. What that is doing is creating higher real yields, the amount of yield you get after inflation. So take the 10-year bond at a 163, take year-over-year core inflation at 1.3, and that's over 30 basis points of real yield. It doesn't sound like much until you go back to last summer when it was a negative 1%. So you have a bond market that is projecting growth, and you have other bond products which are projecting not fear of higher interest rates, but really compatibility with a much stronger economy. We'll be back to you next week, and we hope you have a good weekend. Thanks a lot.